Alright folks, so in my second last video, I told you about two defense stocks to buy that could become the next Palantir, and you guys absolutely loved that video, forcing me to make another part of it. So here we are. In this video, I'm going to tell you about two more defense stocks that have the potential to become the next Palantir. And let me be clear, these aren't just random small cap names. These are real companies with real government contracts, solid financials, and most importantly, a bullish growth trajectory that checks all the boxes for what the next Palantir should look like. We're talking about companies on the front lines of innovation in national security, aerospace, and defense, and ones that could reward early investors in a big way. So if you're serious about investing and want to position yourself early in companies that could deliver massive upside before the rest of Wall Street catches on, make sure you watch this video till the very end. And if you're new here, make sure to hit that subscribe button and turn on notifications so you never miss an update on the hottest stocks in the market. Let's aim for 100 likes on this video so more people can reach and benefit from this info. And remember folks, this video is for educational purposes only. I am not a financial advisor, and this is not a financial advice. Make sure to do your own research before making any investment decisions. Now let's jump right in. The first stock that I think could become the next Palantir is Redwire Corporation, trading under the ticker symbol RDW on the New York Stock Exchange. Now, on the surface, it might look like just another defense contractor, or maybe even a mid-tier aerospace player with a decent product line. But what makes Redwire different from the crowd, and potentially explosive for long-term investors, is how it's transforming itself into a fully integrated autonomous operations powerhouse. This isn't just a traditional hardware manufacturer. Redwire is operating at the intersection of aerospace engineering, national security, and cutting-edge autonomous technology, exactly the kind of cocktail that drove Palantir's meteoric rise. And here's where it gets even more interesting. While Palantir built its empire on data and AI for intelligence services, Redwire is building its future on delivering the hardware backbone and operational autonomy for next-generation defense and space systems. It's a different lane, but with a very similar destination: massive, scalable government and military contracts. What really sets Redwire apart is its evolving offering, especially since it doesn't only cater to the old-school defense world. Its focus on innovation and integration makes it especially attractive to a younger, more tech-savvy investor base. Redwire's products and services are futuristic. They're creating space infrastructure, developing digital engineering systems, and now, with its acquisition of Edge Autonomy, diving headfirst into the booming market of uncrewed airborne systems. These aren't just buzzwords. This is the infrastructure that will power autonomous national defense, global surveillance, and AI-integrated aerospace missions. That alone makes the company relevant for next-gen defense strategy, and also resonates strongly with younger investors who understand that the future of warfare, intelligence, and aerospace isn't going to be boots on the ground. It's going to be bots in the air, satellites in orbit, and decisions made through machine learning. And these futuristic offerings are not only making Redwire different, but they're also making its stock one of the most attractive plays at its current price point. As we can see from its recent performance, Redwire's stock has been on a clear bull run, up over 123% from its all-time low. That kind of momentum in the defense space is rare, especially for a company that still has a relatively small market capitalization of $2.28 billion. It suggests that smart money is beginning to understand the long-term value proposition here. Hedge funds are starting to build positions, and analysts are beginning to revise their price targets upwards in response to strategic developments. And Redwire is not just coasting on hype. It's aggressively working on scaling its business model and expanding its operational footprint. The most significant move in recent months came on June 13th, when Redwire made headlines by acquiring Edge Autonomy. For those unfamiliar, Edge Autonomy is one of the most respected names in uncrewed airborne system technology, and this acquisition essentially transforms Redwire's business model overnight. It allows the company to offer fully integrated autonomous operations for defense and national security purposes. This is no small pivot. It's a game-changing acquisition that adds 1,300 skilled employees and a massive 628,000 square feet of additional manufacturing capacity spread across the United States and Europe. That kind of operational expansion means Redwire is not just talking about innovation. It now has the personnel and infrastructure to deliver on it at scale. This acquisition also significantly strengthens Redwire's positioning in the global defense market, particularly in Europe, where national defense budgets are projected to grow aggressively in the coming years due to geopolitical tensions. Analyst Scott Buck from H.C. Wainwright recognized the potential immediately. On June 24th, he reiterated his buy rating on Redwire and gave it a $26 price target, representing a potential 56% upside from its current trading level. Buck noted that the Edge Autonomy acquisition would not only add immediate value to Redwire's revenue, EBITDA, and free cash flow, but would also create fast-track integration opportunities across defense ecosystems, particularly in NATO-aligned countries. In a world where autonomous defense and space capabilities are now a national priority, Redwire is aligning itself perfectly with future demand. Now, let's zoom in on Redwire's recent financial performance to understand the full picture. For the latest quarter, the company reported revenue of $61.4 million. Yes, that's a 30.1% year-over-year decline and a 16.5% miss versus Wall Street expectations. On paper, that might seem like a setback, but context matters. The company is in the middle of a strategic overhaul and realignment. More importantly, Redwire beat earnings expectations in a big way. Its EPS on a GAAP basis was just -0.09, crushing analyst expectations of -0.35. That's a staggering 74.5% earnings beat. Even more impressive, the company's adjusted EBITDA was -$2.27 million, just slightly below the expected -$2.04 million, indicating that Redwire is managing its transition efficiently and with discipline. Its operating margin came in at -17.1%, which is admittedly a step back from the -4.1% margin from the same quarter a year earlier. But again, this is part of a growth phase. Growing companies spend more upfront. What should really grab investor attention is Redwire's forward guidance. Despite the quarterly revenue dip, the company reaffirmed its full-year revenue guidance at $570 million, which is well above its recent run rate. That signals massive expected growth in the coming quarters. Even more impressive is the company's EBITDA guidance for the full year, which now stands at $87.5 million, more than double the current Wall Street consensus of $36.82 million. That tells us management is confident that the Edge Autonomy acquisition will generate immediate financial impact. And with a $291.2 million backlog in place, Redwire has a solid foundation of contractual revenue to back that confidence. So when you step back and look at the full picture, Redwire is not just a speculative play. It's a company in the middle of a fundamental transformation, supported by strong analyst coverage, a growing backlog, expanding infrastructure, and now a critical foothold in the autonomous defense sector. It may not have the media buzz of Palantir just yet, but it's checking all the boxes that made Palantir successful: government ties, tech-forward innovation, and a scalable business model that plays into long-term geopolitical trends. For long-term investors looking for the next breakout name in defense and aerospace, Redwire might just be it. The second stock I think could follow a similar trajectory and become the next Palantir is Cadre Holdings, trading under the ticker symbol CDRE on the New York Stock Exchange. Now, Cadre might not immediately sound like a futuristic tech player. It doesn't have satellites, it's not building autonomous drones, and you won't see any AI-infused dashboards in its marketing. But that's precisely what makes it so compelling. Cadre is doing the hard, gritty, essential work of building survivability and safety gear for military, law enforcement, and emergency responders. And in a world where geopolitical tensions are escalating and where global security is becoming a daily concern, companies like Cadre become absolutely indispensable. What makes Cadre stand out from the rest is its product portfolio, which focuses on equipment that protects the people who protect everyone else. From bomb suits and tactical vests to advanced EOD tools and public safety equipment, Cadre provides mission-critical gear to customers that include the U.S. Department of Defense, state-level emergency services, and allied military forces around the world. But it's not just the product offering that makes Cadre attractive, it's the way the company is structured. Cadre has built its business around long-term defense procurement cycles, which means stable, recurring revenue. It's not as flashy as Palantir or Redwire, but it's incredibly resilient and strategically vital. And that resilience is starting to show up in its financials and stock performance. Cadre's share price is currently hovering around $32.77 and has climbed over 114% from its all-time low. That's a major move for a company with a market cap of just $1.31 billion. Investors are beginning to recognize the long-term value of Cadre's business model, especially as global demand for military and public safety equipment continues to rise. Now, not everything is perfect. On June 13th, BofA analyst Ronald Epstein downgraded Cadre from a buy to a neutral and lowered the price target from $45 to $38. He cited concerns about the company's reliance on inorganic growth through acquisitions and noted that the cost of borrowing is expected to rise, which could dampen financial performance in the short term. However, many analysts view this downgrade as overly cautious, especially considering Cadre's underlying performance metrics. Let's dig into those metrics. For Q1 fiscal 2025, Cadre reported net sales of $130.1 million, which was down from $137.9 million in Q1 2024, a 5.6% decline year over year. but the company still beat analyst estimates of $126.2 million. The dip was largely attributed to an unfavorable product mix and lower volumes in alpha safety and EOD segments. Again, a temporary situation rather than a systemic problem. More importantly, Cadre increased its quarterly order backlog by $22.4 million. That's huge. It means demand is not only steady, it's growing. Even more telling was Cadre's EBITDA performance. The company reported adjusted EBITDA of $20.5 million, well ahead of the $16.2 million estimate. That gives it a 15.8% EBITDA margin, a strong result in a manufacturing-intensive industry. Operating margins also improved, rising to 10.4% compared to 8.7% in the prior year. This tells us the company is not just growing revenue, it's becoming more efficient and profitable. And it raised its full-year revenue guidance to $633 million, up 7.9% from its previous midpoint guidance of $586.5 million. That shows confidence from management and is exactly what long-term investors want to see. There's one slight caveat. The company's updated EBITDA guidance was set at $117 million, just below analyst estimates of $118.2 million. But given the company's margin growth and backlog expansion, that feels more like cautious forecasting than a real downside risk. Cadre is a company that might not seem revolutionary on the surface, but it plays a critical role in the defense and safety ecosystem. It's fundamentally strong, growing in key areas, and expanding its operational margin. And much like Palantir in its early days, Cadre is operating in a space that's rarely in the spotlight, but crucial to national and global security. With increasing geopolitical volatility, rising defense budgets, and a growing focus on safety infrastructure, Cadre could be poised to deliver steady, compounding returns over the long term. For investors looking to diversify into defense but with lower volatility and solid fundamentals, Cadre Holdings deserves serious consideration. To wrap things up, these two defense stocks that are quietly building the kind of strategic advantages and operational depth that made Palantir such a phenomenon. Whether you're looking for a high-growth, transformation-driven play like Redwire or a durable, margin-expanding essential supplier like Cadre, these are two names you don't want to ignore. If you enjoyed this breakdown, make sure to hit that like button, subscribe for more in-depth stock content. Thanks for watching.